best to make it a great close to the event. All right. All right. So as it titled, know where the market is, where it's going. Is that the latter is really the most important part, and what you want to learn, and what I'm going to deliver to you guys here today. In reality, for me to just tell you where the market is right now wouldn't give you all that much value. Um, However, what my goal is here, and as I go through this presentation, you're welcome to ask questions. We don't have to wait till the end. I like the questions, the interaction back and forth. If it's something I'm going to cover, I'll certainly let you know. But what I'm going to share with you today is to teach you an exact method how to interpret market direction and turning points that you can use for the rest of your trading career. And while we're going to talk about as it applies to the market here right now, you can apply this to anything. It's universal. So I saw some of the comments you guys asking about FX or E-minis. Some of you trade stocks. You can apply this to anything, and you apply it to any time frame of your choosing. I saw some questions. What's the best time frame for this or that? And the answer, guys, is there is no right or wrong time frame. It's a choice. It's about understanding how to use a couple of time frames together in a plan. But there's no right or wrong. There's no best time frame. So I know some of you might be starting out on your educational path into the markets, and that's a common question. I know it's something that I questioned and thought of. So I hope that helps in that you've got a lot of information to sift through in this educational process as you hear different presenters with their views on how to trade, and you're going to have to figure out on your own what sounds like it works for you. And it's kind of a trial and error process, and it takes some time. So I would say is give yourself that time and figure it out. Don't jump in there and lose some money right away. What I'm going to show you is based on price. You're not going to need any indicators. You're not going to need any fancy lines, and it's just going to be a matter of following what is on the chart, as I said, in the time frame of your choosing. Right? So let's get going here. And as I said, you have questions, you're welcome to ask. A little bit about Pristine. I won't spend too much time on it, but we've been educating traders and investors since 1994. Probably the oldest educational firm that you're going to find out there. We've been doing this, before there was really an internet. We started out sending out a fax, multiple fax machines sending out a letter, which we still do to this day. And I'm gonna show that to you. You're gonna show a piece of it at the end. I think you're gonna find it pretty interesting. And the mission of Pristine on the bottom is to make you a self-reliant trader or investor. That's what everybody's goal is. And while all of us here that are educating you today, showing you how we delve into the markets, your goal has to be to get that information and make it your own. I mean, that was my goal when I started out. It wasn't the type of information that's available today. There was very little educational information when I started out, which was in the latter 80s. Very little information, no internet. It was a time of 286 computers and 2,400 baud modems and downloading data. And see Jeff Gibby's here from Metastock, and back in the day, I mean, I still use the program today for some things, but when I started using Metastock many years ago, it was a DOS-based program, and I downloaded data over that 2,400 baud modem and typed in DOS commands to eventually look at charts and the scans, the explorers that he showed you. That was done and through that DOS program, and it took a lot of time. So it virtually could take a couple of hours of downloading, copying data, running explorations, and so on before you even got to look at a chart. And it happens in a matter of minutes today. So I say that so you can appreciate the technology that you take advantage, or can take advantage of today. That when I started out, it was basically back in the Stone Age, so to speak. Let me just get the pointer out here. Helpful. This is my latest book. If you want to learn about Pristine and the method that we use, and how I evolved into my interpretation of the markets and trading, which you're going to hear in part today, this book is a great start to doing that. Son. Well, I don't know how old your son is, Rick, but I would tell you that I'm assuming he's young, and there's no better time to start when the mind is he's 30. Okay, my son's going to be 30 very soon, so we're both showing our age here. But what we start out teaching in our foundational course, the TPM, it's perfect for him. I mean, it's universal, of course, whatever you're going to trade, but I'll explain a little bit more. I want to get into the material, but I mean, we get into specialty type courses and more, deeper into the analysis. But if he's a beginner, it's perfect, because let me tell you something. That one of the things that you all will have to overcome is being inundated with too much information. So you see different trading styles, and if he makes a choice starting into Pristine, and these type of events that Trading Pub is happening, is great, that you can get a taste for different styles and say, hey, you know what, this one kind of hits home with me. It makes sense to me. So I'm going to go there, and that's what these events kind of they're really about, besides giving you education. So any of our instructors will explain the material in slightly different ways, but it's the the foundation of the material that's delivered. Okay, all right. Guys, this is where I felt like I started out, many years ago, because this is how you're told it needs to be done. With these various indicators, and there's hundreds of them, which and I use so many of them, and my charts would look like this, and I'd have all of these indicators and looking for them to line up for the the signals, which would virtually ensure a profitable trade, and I found that it didn't work out that way. And then you get into tweaking these settings. I heard or saw some of you typing in, what are the settings that presenter was using? Well, the choices of settings are endless. So you have hundreds of indicators. An endless amount of settings that you can choose from. So the question becomes, which ones are the right ones, right? Which ones work? Well, I came to the conclusion that none of them work. While they can work at one point in time, as you change time frames, you change a different tradable instrument, or the market environment changes, they can work and then they don't work. And the light bulb moment came on for me when, well, first it came from the realization that, what, if I don't change something, I can't do this. I better go back to what I used to do, because this isn't working for me in this way. That I decided, well, if I continue to do the same thing with all of these indicators and Bollinger Bands and Fibonacci lines and trend lines and so on, it's not going to work. So bottom line was, get rid of it. And as I took it off the chart, it started to make sense. the light bulb started going on. It's like, hey, this is just about trends and support and resistance, and recognizing certain patterns when they set up in certain areas, and that worked, right? But all of this esoteric stuff, was just mass confusion, right? Candles can keep you on track, so training is an absolute. Reading the charts is so important. Well, candles are a part of it, but even candle patterns, Rick, and all of you, a pattern that sets up, that isn't set up in the appropriate place, will lose you money just as fast as pressing the button with a blindfold on. They don't guarantee anything, so, and you've all seen that. You've seen, well, here's the textbook, dark cloud cover or piercing pattern or whatever it might be. And it's like, oh, it worked in the book every time. Why didn't it work today? I'm going to get into some of that as we go on. But, the point here is that if you start removing this stuff from the chart, and that could be a little unnerving at the beginning, because I know you've been inundated with this is how it's done. And I know it was a little unnerving for me because, it was like, it's taking a risk. I'm told that this is how it's supposed to work, but, I just said, well, I got to get rid of it because it's just not working for me. And you see, there isn't even any horizontal lines on this chart because those became, created thoughts that prices might stop there. I removed it all, and if prices are going to turn at a point, odds are it's going to turn because there's some prior resistance there or prior support. Well, we decide what time frame we're going to trade from, and one of the things that we do as part of our learning process is to understand the markets and what they're doing from a long-term point of view. I agree, Rick, absolutely. Where you're using them, it can feel like a security blanket because how many books did you read or times you saw that how they worked? And it's like you think that it's supposed to work. Again, you have experiences that it didn't, so you get conflicted. So I wanted to understand, what moved the market. I wanted to have a way of determining when there was a high degree of risk in the market. We're all fearful to some degree about losing large amounts of money because of not having a knowledge of what's happening. And so I went on a process of, trying to figure that out along with everything else. And I had to go through, things like cycles and Elliott waves. I didn't spend too much time there. It seemed a little ridiculous to me, waves inside of waves and so on and so forth. The moving average crossovers, which ones? Simple moving averages, exponential moving averages, weighted ones, and there are others. Trend line breaks. I mean, I can remember, reading Barron's magazine many years ago and seeing a full page write-up with trend lines on the S&P and how, the S&P violated this trend line that was 15 years long and the market was going to, go down and, for who knows how long. What did it do? Popped right back up above the trend line, and started going up. So redraw the trend line, and it's like, come on, that just doesn't make sense to me. That here's this line that is supposed to be so significant that it's, over a decade long, and the market, the uptrend is now broken and it pops back up and starts to rally. Well, there's something more here to this. It's kind of like, my brain kind of tries to work in a common sense kind of way, in a basic way, so that these kind of things that are supposed to be so significant and they don't follow through. I was like, well, I got to figure this out. There's something else here. And then there's all of these, bear markets, super cycles, Santa Claus rallies, and so on, and they do have some effect. If I have strength in percentage, I'm not following the question. Rick, I think if you're saying if you're talking about relative strength and weakness, yeah, that's something definitely to consider. You know, comparing one move against another. Um, I would say most of the time, Randy, and I'm going to show that to you. I'm going to show you exactly what I look at and what has worked for many, many years. All right. Obviously, there's no guarantees, and you know, because of where we are right now in the markets, I'm going to show you one setup that didn't work, so that you can see that, and then what happens from there. I mean, you know, that's how we learn. And then different choices as to what to trade. And this is a big deal because, you know, you hear that, hey, it's commodities, you know, no, trade value stocks or growth stocks or E-minis. Well, the truth of the matter is you can trade any of them, any of them. The point is which of them are in favor at the moment. So I've traded E-minis for a lot of years. I've traded stocks for a lot of years, and I've seen both where they've been great opportunities, and I've seen both where they were awful to trade because they were in favor or out of favor at a moment in time. You know, so you know when volatility is low, trading the E-mini markets are not all that great because they tend to be really choppy. When the VIX, or the volatility index, starts to rise, the E-mini markets become more attractive. I trade the uh, currency futures, Rick. I've never gotten into the FX. You know, I mean, to me, a chart's a chart, and it makes no difference what it is. It's just, you know, the futures market is easily accessible to me because I don't have to open up an FX account, which isn't a big deal to do. But if I want to trade the euro, I can trade the euro futures. What in favor or out of favor means, James, is that prices are trending. Good question. Essentially, it means prices are trending. So rather than chopping around and going sideways where you have a lot of overlapping price bars, you know, basically being directionless, you know, when prices are overlapping each other, the bars are overlapping each other and the ranges are relatively small, you're just going to get annihilated trying to trade that. It's like, you know, banging your head against a brick wall. But, you know, go and trade, you know, how about Telsa, you know, this electric car company when it was going from 50 to 100. You know, it's in favor. Everybody wants it. You know, find what everybody wants and is trending and has room to move. George, this isn't the place to answer that, but if you come to one of our workshops or, you know, email me directly, you know, but I would just suggest to you that you do a little research on the internet and you'll probably get the answer to your question. You know, as far as economics, you know, so many economic reports. How do you sift through all of this information? You know, the CPI, what the Fed is doing, you know, employment reports. So, you know, my goal was to simplify the mass amount of information and decision making process that there was into something that was manageable and relatively simple. Relatively simple. Right? And that's what I'm going to show you today. No holds barred, no proprietary indicators. You know, you're going to walk away from this presentation with a way to do this on your own Monday morning. Right? So who are you relying on? You know, for me, I want to rely on myself. I don't want to, you know, I may have to pay somebody for education and knowledge to speed up the learning process, but I want to get to the point where I don't need you. And that should be what your goal is as well. Right? You get a recommendation or someone tells you about fundamentals, you get a tip. And you know what? And everybody, you know, puts down, oh, a tip, you don't trade tips. Well, I don't mind trading tips. You know, I can turn on CNBC and watch Fast Money. To me, that's a tip. But it might point me in the direction of something that, or somewhere where I wasn't, and I can look at that and I can make an intelligent decision myself. Great, right? Well, not necessarily, BH. Not, you know what? To some extent, I hear what you're saying, but you know, again, someone, a tip, let's call it a tip, or somebody just saying, hey, you know what? Look at such and such. Something's happening over there, or I heard about this. So I'm using it in a very broad sense. Um, I'm just saying it's something that draws your attention to a market or a particular stock. At that point, it's up to you to decide, is it already happened? Is it halfway happened? Did it just start? All right. That then it becomes your job to take that information or use it or say, hey, you know what, this is garbage. It's not, it's worthless. So what to do here? All right. This is easy. It's easy. Of course, I'm going to show you exactly what to do. All right. Sentiment. You want to know. Um, we want to know how other traders are feeling about the market. Right? Are they bullish or are they bearish? Um, and we can measure that, and it's easy. The information is readily available. All right, the monetary environment is the Fed pumping money in? Is it pulling out? And most importantly, has it reached a point where there's a large amount of risk, or is there great opportunity? Price extremes, market strength, weakness. When overbought or oversold. I don't even like those terms because they typically relate to indicators like stochastics and RSI and so on. Um, I'm going to show you, Kenny. I'm going to show you. We're not going to walk away from this without you knowing everything here and being able to use it Monday morning. Um, you know, overbought and oversold. These are subjective terms, and they create thoughts and beliefs. Overbought meaning it creates a belief that prices cannot continue to go higher, right, or oversold lower. And what do we see when we look at an indicator? I know what I used to do when I used to put these indicators on the chart. I said, oh, the stochastic is overbought. Prices cannot go higher. And they'd go higher and higher. And the stochastic would be going sideways at the top of the chart. So I'd say, oh, I must have the wrong settings. I changed the settings, and oh, now I see it's starting to line up. And then I'd go to a different stock, and it didn't line up anymore. So using indicators that mimic price, it's basically useless. You can just follow price itself. And one of the most important thing is determining the trend. Right? Is it up? Is it down? Has it changed? And how do I do this in multiple time frames? Because as the last point there, it says price is king. When I say, well, I'm not saying, BH, that might be exactly the right thing to do, but when you have confidence in your method, right, there's nothing to run in the other direction for, because you are going to make a decision based on your trading method and plan, or you're going to walk away from it. So you can look at it without being concerned in a sense that, like, oh, I'm afraid I might press the button on that because I was influenced by a great story. It's not like that when you have confidence in the method that you use. All right, so here are the tools that we're going to use. Right, for our sentiment gauge, I'm gonna use the CBOE put call ratio, the day-to-day closes, and a 5-period moving average of that close. For the monetary environment, I'm going to use the yield curve. I'm going to look at the difference between the 30-year interest rates and the 3-month yields. I'm just going to subtract one from the other, and you could either just do the calculation yourself, the subtraction, or you can plot it. I'm going to show you a chart of it, and you're going to see what, be aware of when it gets to extremes. And it takes very long for it to get to extremes once it starts moving. So it's not the type of information that is going to influence the market tomorrow or next week, but I'm going to show you why it's so valuable to use it. I would totally disagree with you, BH. So we'll leave it at that, and you can study it longer. And I think eventually you will come to my side of it, and you know, to me they're totally useless. But hey, you know what? That's my opinion and my choice of how I interpret what's happening, and everybody has that choice. And I know I'm fighting the trend, so to speak, because everybody's inundated with the indicator methodology. To me, it's like a lot of hocus pocus. Price extremes. I'm going to use the McClellan oscillator. I didn't invent this. It was created by Mr. and Mrs. McClellan. It's an excellent indicator, short-term indicator, and a measurement of strength internally of the market. It looks at thousands of stocks, and it just looks at the difference of two moving averages, a 19 exponential period moving average and a 39 exponential period moving average of advancers minus decliners. It's really simple. And again, this is available free at many places on the internet. Nothing I'm showing you here is proprietary. And determine the trend. We're going to spend a little bit of time on this to explain it in great detail, but this you will find is the only thing that you need to determine a trend and trend changes. I don't know how to read a chart. Well, all right. I won't argue with the BH, but you know what? I've been doing this for a very long time, and I would say a lot of people would disagree with you, but hey, we'll leave it at that. So a long-term bias, and your reaction is something that that I've dealt with before, in that people, when you tell somebody something that alarms them in a sense, they get defensive about it. But so my long-term bias, I'm going to look at the monthly trend and the yield curve. Right? For my intermediate term bias, I'm going to use the weekly trend, this McClellan oscillator, and that 5MA of that equity put-call ratio. And short term, the daily trend and the day-to-day closes of that put-call ratio. Why the McClellan oscillator? Because it's a measurement, Lou, of advancing minus declining stocks. So rather than using an advanced decline line, it acts like an oscillator up and down that gives you an objective measurement of when the market has reached extremes. And it's something that you could look back over decades of time, right, in a sense, to back test it, if you will, to say, this has been an excellent measurement of short-term points in the market where it's likely to pull back or bottom. And I'm going to show it to you. I'm going to do that, Robert. Again, I'm not going to leave here without you knowing in detail everything that I've come to explain. All right? We're going to spend a little bit of time on this, defining the trend and the trend change. Right? I said most of all of this stuff, you can find at stockcharts.com or the cboe.com. I write a chart of the week. Comes out on Mondays. It's a free service that we do. We also have a pristine Facebook group where I post charts there. You're welcome to join and review those. Well, I don't think so, Lou, because you could probably write one yourself, but since the McClellan is looking at several thousand stocks, I'm not sure exactly how many. You could take anything and subtract one moving average from another. You'd have to make a composite type of indicator, and I'm not even sure how that would make any sense to FX. Looking at something more like the interaction between interest rates and gold and other commodities would be probably a better piece of information for determining what's happening in the Forex market. But what I'm going to show you as far as trend changes, you can apply to the FX market, and you could do that easily. Well, Luke, I would disagree with you. I mean, they give indications, but they're actually gauges, right? They're not indicators. I mean, we're kind of just talking semantics here, but you know, to me, they're gauges of what's happening. You just go to the website and you know, to get chart of the week, you just put in an email address and log in, and you know, you go to the free services. There's a lot of information there. Um, you know, that's free things that are on there. Lessons of the week, um, Eyes of the Pristine Trader. A lot of great stuff at the site. You know, just go in there, log in, and check it out. So here's a chart with what I am talking about here, and I've got the spiders at the top, this McClellan oscillator in the middle, and that put-call ratio at the bottom. And what I'm looking for here is when this McClellan oscillator reaches an extreme, right, up above 100 toward 200, and option traders are buying an excessive amount of call options. And I want to see this 5MA get down here around 0.8. And historically, that tells me that these option traders, which I'm not going to get into it, BA, BH. I mean, you can look at indicators. To me, these are gauges or measurements of what's happening within the market. They're market internals, right? So what this is telling me is how traders feel about the market. Right? If they're buying a lot of call options, they obviously think the market's going to go up. Option traders historically have a very bad track record, especially at extremes. Right? So when they're buying an excessive amount of call options, bullish bets, the market historically has pulled back from there. Now, that in and of itself isn't enough. I want also that this McClellan oscillator, this measurement between advancing and declining stocks, to be an extreme as well. And so as the market moves higher, prices or stocks have moved too far, option traders are buying too many calls, I know I'm getting close to a pullback within the market. From that point, it's about price. This just gives me a bias as to what's likely to happen relatively soon. At that point, once you have this information, that's when things like candlestick patterns make sense. Right? So to get a topping tail or a spinning top or a doji, you know, on the way up within a move higher, right, before you've got these internal gauges suggesting a pullback, you're more likely to get run over. And as the market pulls back, I'm looking for the same thing. Stocks have moved too far, right? They're too bearish, and these option traders are just loaded up on puts, thinking that, hey, the market's going to crash. Right? Well, you see here the S&Ps, the spiders didn't, they popped a little bit, but it didn't start an uptrend. Right? But it told me that I was in the area of a likely point in time where the market would probably turn around. You know, from that point, now it's about the trend analysis, and we're gonna get to that. So I need both of these internal gauges to reach an extreme, not just one. I want to see that 5MA, like it was down here, right, in between my red lines around 0.8, and this McClellan oscillator to be above 100 and toward 200. And the prices were in a nice uptrend here. Right? But my internal gauges told me, be careful. Right? You know, breakouts are more likely to fail here. Right? Continuation patterns are more likely to fail here. Right? Then you wait and say, you know, do you get breakout failures? You know, a big part of what I look for and what we teach is how to utilize failure patterns at the appropriate time. The CBOE put-call ratio, Richard, you can just go to the cboe.com. The information is there. They have historical data. You can download it in an Excel format. You can use it as you know, chart it. There are different options, you know, that you can use. Of course, I don't use the index options because they're almost always bearish. You can look at the equity options ratio, but the CBOE put call ratio looks at different indices, right, as well as equities. It's a combination. So I just continue to follow this, and I look at this chart on a daily basis. Takes me all of about 10 seconds just to see are both at extremes, and from there I move on. It's all set, Robert. I don't use, it's not parameters of my choosing. What was set up by Mr. and Mrs. McClellan, I don't know how many years ago, is just the difference between a 19 exponential period moving average and a 39 of advancers minus decliners. And so it's something that's set. Most charting software packages have this in it. It's not something that you have to buy. As I said, you can go to different websites where you can. It's there. Nothing I'm showing you here is something that you'd have to spend money on. George, I just use it as it comes, as it's related to the broader markets. Right? It's just simple. I suppose it could be used in other ways. Yes, on a daily chart. And I think I remember from years ago. There's a site where the McClellans have a site, and they have used this on different tradable instruments. However they do it, so you could search it out there. I just use it on the broader stock markets. So on this slide, what I'm showing here is an example of a point in time where the spiders were pulling back, and the McClellan reached an oversold reading. The daily closes got up to an extreme, but the 5MA wasn't at an extreme yet. So it wasn't a complete signal. And that's all I want you to take away from this slide here, is that, I want that 5MA to be an extreme with the McClellan at an extreme, and then it's about watching price. No, Alan, I mean, the equity put call ratio, you could look at it. The information's there at cboe.com. I'm using the CBOE put call ratio. Some programs might refer to it as a total put call ratio. Bob, I just explained that. I put the red and green lines on there. That's not done by a computer program. And there's no kind of programming. I just did this in PowerPoint to just point out, both of these were in an extreme at that point. Both of these were at a bearish extreme at this point. And so I just did that for visual effect to show you when it was at extremes, and then you could see what happened in the markets. I'm looking at the difference between long-term interest rates and short-term interest rates. These are the symbols, the 30-year and the 3-month. And all this chart is just showing is subtracting one from the other. Right? There's nothing special here, proprietary. You can do this with virtually any program, or you can just get the two quotes and subtract one from the other. And what we're interested in is to see when it gets under 5 and ultimately below 0, where it tells me that short-term interest rates are higher than long-term interest rates. And as this says, this is the Fed's only proven predictor of recession. This isn't mine. Right? I didn't create put call ratio. I didn't create the McClellan oscillator. I didn't create this piece of information. And I did research and found out what works and put it together. Right? So if you search this on the internet, what you'll find is that the Fed did 2 studies. And I forget the years they did it in, but I think it was possibly 96 and 99. I don't remember exactly. and they back tested various economic data or information that what would predict a recession. And in both studies, this was the only predictor that had any reliability. It was an inverted uh, inverted interest rates, right? Where the short-term interest rates got above the long-term interest rates. And you see here in 2000 when the internet stocks, were just, soaring higher, doubling, tripling, quadrupling. This information said, hey, you know what? It's time to be careful here. You know, something bad is going to happen here. And it took time, but eventually it did. And the same thing over here. It's, at the end of 2006, as it got down here. So simple information, good information historically over the years, it's worked really well. And when it gets above 3, it's just that it tells us that there's a lot of liquidity coming into the system. The Fed is just, pumping money in here, and it's going to help support the broader markets eventually. It doesn't mean it's going to happen next week. It may not happen next month, but this is a long-term piece of information that, will put us on a right bias that change is coming. Here's the chart with the spiders, and you can see, virtually the timing of it. It's not exact, but it told us when trouble was coming here. And over here, it told us, hey, there's enough liquidity coming into the system that the market should bottom. It happened, almost a year later, the bottoming process. So say it again because I know when we look at this type of information, it has a tendency to make us think that change has to come relatively quick. And this piece of information, change doesn't come quick, but it's great information to be aware of. And it's still bullish. It's still bullish over here. So when we hear about, the Fed might start tightening, in another year, or they're gonna, the QE is gonna stop, and what have you. That's okay, because even if the Fed begins to raise interest rates, historically, that is not a time when the market's going to go down. Not in a serious way. It may pull back a little bit. It'll have its gyrations because of the fear of that. But historically, the markets have continued to move higher when the Fed initially starts to raise interest rates. Not until this yield curve gets inverted is there going to be real trouble. All right. Determining the trend. Trend changes. As I said, you can apply this to anything. And whatever the time frame is that you want to use it, you apply it to FX, E-minis, stocks, oil, makes no difference. No need for trend lines, fib lines, Elliott wave, Gann lines. This is it. I've studied it all. This is the only objective way to do it. And it's simple. You think about it, it's common sense. The definition of an uptrend, higher highs and higher lows. I think we could all agree on that point. And it's vice versa for a downtrend, lower highs and lower lows. If it breaks that definition, the trend is broken. Right? It's simple. And I don't need a trend line for that. So all I need is to define the highs and lows. And as prices are moving down, each time it makes a lower low, I will mark off the prior swing high. And I'll just call that, for my own benefit, my own words, my choice, I'm just going to call that major resistance. And if prices can push through that major resistance, this prior swing high, it's no longer in a downtrend. It's not in an uptrend yet, but it's not in a downtrend. And by pushing through major resistance, as I have defined it, will violate a downtrend line. However you're going to draw it, it'll violate it every time. It has to. Right? So it makes it black and white, and that is, in part the goal here is try and remove the gray areas from the technical analysis that we use as much as we can. in an uptrend, every time it makes a higher high, I will mark off the prior low and call it major support. And I will continue to do that as long as it continues to make higher highs and higher lows. If it violates that major support, it's no longer in an uptrend. Of course, this applies across multiple time frames. So again, we want to start with higher time frames and we start to work down. Now, just to clarify this piece of information, because it's a question that always comes up, either in one of the workshops or coaching sessions that we do when talking about it in a class, is that, well, what happens when it makes a lower high and a lower low, but it hasn't violated what we label as major support? Well, since it didn't violate major support, it's still in an uptrend. And many times, this pattern of a lower high and a lower low is a great opportunity where we want to buy. In addition, what you find is that if you were to switch to a higher time frame, it just looks like a normal pullback within an uptrend. So, if you're following, these higher highs and higher lows, and you see the pullback like this, and it often happens after, a little bit of a larger run, and prices need a little bit more correcting, you'll see this pattern, and it's often a great time to get in where prices then resume that trend. This slide, guys, is something higher pivot, Antonio. I should have said that. Thanks. Higher pivot. This slide is what you want to focus on or think about looking for these trend changes that happen in smaller time frames. Because without the understanding and analysis of what's happening in a higher time frame, you often are going to get caught on the wrong side of the move. Time frame, in a lower time frame, trends can change. In other words, if I go down to a 1 minute chart or a 30-second chart or a 50 tick chart, trend changes can happen back and forth all the time. But how meaningful are they? When are they meaningful? Because at a certain point in time, they are. Same as what I said to you about a candlestick pattern. An evening star pattern or whatever you want to call it, a shooting star or whatever. When are they meaningful? Right? Because there are going to be plenty of times where you're going to see that and it's going to be totally ignored and prices will keep going higher. Well, when a higher time frame has rallied up into an area of resistance, and you see up here is where the turning point begins. And so let's assume that here's a run into this area of resistance and you see that doji, right, or that gap, that doji that gaps up, I forget what the name is, and it gaps down, and you see a bar with a tail on the top, that type of a candle pattern here, and you see, well, all right, it's happening up here in this area of resistance, prices have been trending up, and here I go down to the lower time frame, and while my higher time frame is still in an uptrend by the definition Greg gave me, this lower time frame has violated the trend. That's when you want to short a lower time frame, right? Or trade against the higher time frame. That's the appropriate time to do it. When these are in alignment, they're both going up, and getting in, down here, on one of these pullbacks where these are moving together, that's a great place to get long. You have alignment of time frames. But this is how you utilize a higher time frame and a shorter time frame and to trade against the trend of the higher time frame at the appropriate time when it should go down because of an area of resistance, what I'm calling a supply area. That's resistance. That nothing to do with proprietary numbers or Fibonacci lines or any of that stuff. Right, so we have to define these swing points. Right? If we don't define our analysis that we're doing, it becomes hit or miss. It's subjective. So as I said, I want to make this as black and white as it possibly could be. So I make definitions for what I'm going to call a pivot high and a pivot low. And again, I want to keep it simple. So a pivot high, I will define something as a pivot high. For me, Brian, I mean, you can, of course. I don't. What it may become what we call a self-fulfilling prophecy. Right? If you're trading FX or possibly the S&Ps, because you've got a lot of people doing that, but ultimately prices move to areas of support and resistance. Those could be momentary stalling points, the same as a 200 period moving average, but without price in alignment with it, I've just found the majority of times it's just a short-term blip. So a pivot high needs to have a minimum of 2 lower high bars adjacent to both sides. Simply 2 bars to the left and 2 bars to the right. Most of the time you'll get more than that, but we have to define what a minimum is. Right? And when that has happened, I say, well, it's formed some area of resistance. It may not be all that significant. And for a low, I want a minimum of 2 higher low bars adjacent to both sides of the pivot bar. 2 to the left, 2 to the right. And as we follow a trend, right, what we're doing is just following, right, these little gyrations here, right, these highs and these lows. And as it is in an uptrend, right, and begins to pull back, right, it has a minimum of 2 lower high bars to the right. Well, that leaves a swing high over here. Now, in an uptrend, the assumption is that prices will make a higher high. That's why we buy the pullbacks within an uptrend, because our expectation is that we're going to see a higher high. And once it does do that, right, we then go and mark off this swing low over here, and we're going to call it major support. And we're going to continue to do that and follow this as it happens. And every time it makes a higher high, I will then mark off this swing low, and I'll call it major support. And if prices should at some point pull back below that low, it's no longer in an uptrend. This is a simple example of what we would do, just following these swing highs and lows within a trend and when the trend changes. I'll just read this off to you real quick. So at point A, right, point A right here, I've got two bars here, which means point 1 is now a pivot because it meets the definition, but it's not major support because it hasn't made a higher high. Once it does that, right, at B, all right, 1 becomes major support. It's very simple. Very simple. Now, because I put letters, Jackie, it doesn't mean it's Elliott wave. It's just to mark these points off on a chart so that we both know, we all know where prices are. Well, it could be tape reading in a sense, Bill. For someone that's just looking at time and sales and visualizing what's happening in their mind. That's on a very short-term basis. But like I said, the more you go down into smaller time frames, ultimately, looking at a time in sales, the trend is going to change very rapidly. And that, a tape reader, so to speak, or someone trading off a time in sales is, the reason that they trade so often is because they're reacting to that information. And that's a choice. I'm not saying it's wrong. What I'm saying is if you don't want to trade, 100 times a day or maybe more than that, you have to expand into higher time frames. are these swing extremes based on closing? Well, Richard, it has to be a closed bar, but the time frame is a choice. Right? It's what time frame do you want to apply this to? And it's the same thing, I can take it all the way down to, like, what Bill's saying looks like tape reading. Well, I could apply this, kind of hard, it's kind of intensive on the mind to be thinking about prices moving like that and trying to follow, time and sales. But, okay, I would agree you could do that. You could apply it to a 1-minute chart. You could apply it to a 60-minute chart, and swing traders would apply it to daily charts. So we just follow the trend, and we keep marking off these swing lows when it makes a higher high. Well, it says at E it broke the trend. It has now violated the trend as it pushed down through this area. 2 has become major resistance because it made a lower low. So we continue to follow. Right? Major resistance once it makes a lower low. Now over here it says F, major resistance has not been overcome because it did not take out this swing high. And a lot of times this is where trend line use becomes confusing, in that someone will draw a trend line down through the highs and the trend line's broken, but it didn't overcome resistance, and then prices drop again. Here at G, right, then major resistance has been overcome. Here's a chart, the S&P E-minis. Right? This was on the 26th. So prior to that, the hourly chart was in a downtrend, right? Making lower highs and lower lows. And just continue to mark off the highs as new lows are made. Once it pushed up through that, once you've pushed up through it, right, we're looking for it to make a higher low at that point. We don't have to get in at the bottom, Brian. We don't have to get in at the bottom. Trying to get in at the bottom point you can place a lot of trades before you actually get it. Typically, when prices are trending down, right, they pull back and retest a low, and that's the highest probability place to get in on the retest. Now understanding multiple time frames, right? I don't know, 50% of the time, and it happens a lot. And if I can show you ways of getting in near the low, right? You can get a trial to our PMTR chat room and watch Paul trade. He'll show you ways of getting in near the low, but it's with the use of multiple time frames. As prices pull back toward areas of major support, he'll go down to a smaller time frame and look for a trend change or a higher low. So once prices turned here, see the 5-minute just continued to make higher highs and higher lows as it pushed up and eventually came up into this area at 1595 on that day near the open, and prices kind of went flat for the rest of the day as it was, as I say, refers to or absorbs this area of overhead supply over here before it was able to go higher the next day. It's based on the bars, Richard, not based on the closing price. What I was showing you on those prior slides was just looking at a line chart, which would be on closing prices, but we're just using the bars. Like you can see here, it's not the close, it's just the tail of the bar. Once it makes a higher high, I'm just marking off that swing low, or the tail of that bar. I just continue to do that. Here's an example of using it in multiple time frames in Disney stock. This was some time ago, but the idea was the weekly was pulling back into this area. The prior high is what we call minor support. Here was the daily, which was going sideways. Here was the pullback right here, and this is a pattern that I don't know, there's a name for it, but it's one of my favorites where prices are going sideways and then break down under the lows and spring right back up again. That's a great setup, a buy signal that I often use. And on the bottom of this green bar is the pullback on the 60-minute chart, which is right here, and then again following the trend. So at some point in time, this 5-minute chart violated the trend for sure, but on the daily time frame, Disney went up to almost $70. So again, we have to decide the time frames that we're going to use. Right? What I'm giving you is a way of following the trend objectively in multiple time frames. You choose how you want to use it. All right, so where are we at here? Right. Monthly chart of the spiders. I've marked off the times where the yield curve was bullish and where it was bearish. The yield curve is still bullish, and prices continue to trend higher. And you update your monthly chart, right? You could look at it weekly. Obviously it could change, intra-month, but these support areas, these major support areas, aren't going to change all that often. And we're going to follow the trend on the monthly time frame and be aware of where that significant low is. The trend is still up on the monthly time frame. That's black and white. Right? There's no conversation about it. It's making higher highs and higher lows. It is what it is. The weekly trend is still up. So here was that low. You look at the start point there. I put that star over here. Right? This is how you move down to lower time frames to look for entry points with a bias. Down here, it's the same thing I showed you with those line charts a little while ago. Where are prices on that chart in relation to resistance and then the trend change on the smaller time frame? Well, here's just the opposite of that. Down at the low here. Looking at the monthly and then coming down to the weekly, here was the break. Here was the break of the trend, and then prices trending higher. Eventually, it broke major support. It didn't collapse. It wound up recovering and going sideways for a few months and then resumed the trend again. It broke here in 2011, which will obviously change our bias. And we objectively follow what's happening, right? Easy to update on your own, right? Get your little trend tool out, right, and draw a line and mark it off where your reference points are of major support or major resistance in a downtrend. Well, actually, George, that chart was a little older. This is actually much higher now. And you see it pushed up to 170, so it exceeded those highs. But at that time you were right, where it was challenging those old highs. So here's my daily of the spiders and the internals. Right, this was as of the middle of last week, and as prices pulled back here, we got that lower high and lower low while major support was not violated. And we got a retest here, and look at this big green candle. I mean, there was no, way of, in my mind, not thinking that this would go higher, and it began to. I mean, option traders were buying a lot of put options. My McClellan was at an extreme. Part of it got a little bit too extreme because it got down here near minus 300. But this pattern here said, hey, it's time to buy. It wind up failing. And this is, I told you earlier in the presentation that, I was going to show you something that didn't work. So, Not that it works 100% of the time, but it works the majority of the time, and that's what we want. Not necessarily, George. I mean, I've heard people say that, but if you come into what we call the PMTR, the Pristine Method Trading Room, we've got one guy in there, a moderator, Jared, and all he trades is breakouts, and the guy makes money every single month. And he will show you his P&L, right? So it's not some hype, what, I did this or I did that. He will show you the actual, P&L of what he made that day. He'll show you the spreadsheet of his trades when he bought it. He actually teaches a course on how to run a trading business. And all he does is he trades breakouts. So it's how you trade the breakout. Most people just don't know how to do it properly. I do, Jimmy. If you email me, I'll let you know. Right, so option traders still here, they're betting on the market's going to crash. They're betting it's going to crash here. Right, the market's oversold. It's coming down toward these lows here of major support. So this is where it was at. And so what do we do with that? Well, first of all, let's define our areas here. One sec, guys. Let's define these areas here. All right. So as far as numbers go, right? Where's support? All right. You just go look on the chart, right? As I explained it to you. All right. There's your minor support. There's your major support. All right. Intermediate term. There's the numbers. 153 is going to be important because that was the swing low. So if it breaks 153, right, that's going to break the trend on the daily and the weekly. So you can apply this type of analysis to anything. Right? It's simple. It works. Right? If you're an intraday trader, just move it down into smaller time frames of your choice. And I showed you a 60-minute and a 5-minute with the S&Ps. This was the letter on 625. You could read what it said, but essentially it was saying, hey, this is the time to buy. Right? We're looking to put on swing and core positions. Right? Don't expect yesterday's low to hold to the penny. You should begin positions here because the market may be at its low. However, the odds are that we will see one more dip from here, and it may retest this low, where we'll look to add to positions. This is what traders got in the letter, in the swing and position letter on 625. And this is where they started taking positions in the chat room based on this analysis. I got to pick it up a little bit here, get into the end. Go to our website. All right, we do free webinars every week. This was last week's. By the way, we won the Trader Planet Award for the best trading course in 2012. So we've been doing this since 1994. And this is a good way to get to know us in these free classes. This is the class that we got the award on. And what are classes, guys? Right? You get access to what we call the grad room, which is essentially a room where we review every single day, 5 days a week, what you learned in the class. You get a retake of the class. You get 14 days in a home study to review it over and over again. Coaching Tuesday nights. Access to the rooms and the letters. We believe in repetition. I mean, after you take a class with us, we're going to drive it home until you get it. Right? Repetition, hearing it over and over again, coming and asking questions, reviewing trades. That this is what we do on a daily and weekly basis with you. Visit Master Trader. Master Trader is our preferred broker. They'll actually pay for your education through reduced commissions. I don't know where you can get lower commission rates than this, but go and check out mastertrader.com. You know, great platform. They have multiple platforms actually, but excellent commissions, and as I said, reduced commissions until your course is paid for to the penny. These are the specials that we ran last month, and for those of you that are here, right, you can check that out. At that link, and we'll extend this until the end of next week. You can contact Ray or one of our other counselors, or email counselor@pristine.com and find out more about Pristine. As I said at the beginning, our goal is to teach people to be independent and be able to do this on their own, not be dependent on proprietary indicators and software. It's about empowering you and allowing you the freedom to do this on your own forever. All right. As I appreciate you guys all hanging out here, I was last in the lineup, and appreciate those of you that hung around and stayed to listen. I hope you got a lot out of this. And again, as I said, check out the webinars. They're great presentations. I think we do them 3 or 4 days a week. And Morgan, thank you for inviting us. It was great, and hopefully we get to do this again at some time. All right. Have a great rest of this weekend, folks, and hope we'll talk to you again soon.
All right, great. Well, good deal. Well, we really appreciate you taking the time to be with us, and I think that was a great end to a very, very good Saturday class. Did you guys enjoy the class today? I think we had more content, like I said, more content shared in this class than we have probably from any of the classes that we've had up to this point. So again, just yeah, we will record this class, or